So we are going to do part 3 of section 13-1 and talk about long-term financial strength ratios. There are 4 of them dealing with long-term, and again, financial strength is the ability of the company to generate enough cash to pay off its obligations, and we're talking about long-term obligations here. So even in a weak or strong economy, but even in a weak economy, if we have long-term financial strength, then we will be okay as a company. And that strength requires a balance, it says, between capital, stockholders' capital, so equity financing, and borrowed capital, long-term liabilities, or debt financing. So I have to keep some sort of reasonable balance between those two things. So when we're talking about borrowed capital, the key that we need to remember is that we're talking about the fact that you have to pay back what you borrowed as well as interest, so that if your net income in a bad economy goes down or for other reasons, it's more difficult for you to pay back that borrowed money. And creditors are not going to loan you money if you have a really high level of liabilities as well, because they don't want to be one of 5,000 people that you owe money to if things go bad. So let's look at those 4 again, focusing on how to calculate it, what the target is or standard, and then what we do about it in the future. And again, I'd take notes on my Blackline Masters if I were you. So the first one is the debt ratio, and this is taking total liabilities divided by total assets, and it shows the percentage of assets that are financed with borrowing, so debt financing. And for Forest Company, this is how we do it, and again, total liabilities, total assets, both coming from the balance sheet. I would note that. In 2000X3, for Forest, it was 31.9, which says that for each dollar of assets that the company owns, they have borrowed 31.9 cents. And the target for them and their industry is 29 to 33%. And you can see they were outside of that in X2, but now they're back in that targeted range. So in the future, if I wanted to improve it, I would want to increase assets without increasing liabilities. So I could issue additional capital stock or preferred stock in order to increase my assets, so get some cash without doing anything to my liabilities, because it would only affect equity if I did preferred or common stock. The second ratio for long-term financial strength is the equity ratio, and this ratio is found by dividing equity by total assets. So the debt was taking long-term liabilities by assets, this one's taking equity. So it shows the percentage of assets that are provided by your equity financing. And I would write really large, probably on this slide or somewhere, that the debt ratio plus the equity ratio has to equal 100%, because the source of all my asset ownership is either coming from the debt or equity financing. So debt ratio plus equity ratio is 100%. So for Forest, show the calculation again. The total stockholders' equity and the total assets come from the balance sheet. And I calculate this number, and it means that for each, again, looking at this one, 68.1, for each dollar of assets owned, 68.1 cents was acquired with shareholders' capital. And the target for Forest is 67 to 71%. And they are within that, hitting the target as well as it's improving. If I want to continue to improve this or solidify this, then I would want to decrease my liabilities and maybe issue some more stock. So to drive up that numerator would be what I would probably do. The third ratio under long-term financial strength is equity per share of common stock. It sounds exactly what it says, per share. So the amount of common stockholders' equity belonging to a single share of common stock. So that second bullet kind of confuses people sometimes, and when we look at the calculation, it'll hopefully make more sense. But when a company has both common and preferred stock outstanding, then we need to take the preferred stockholders' share of equity out from total to just get to common stock equity. So common equity per share tells the shareholders how much ownership of the company each share represents. So let's look at the calculation, and that'll help us explain it a little better here. So the first thing that I'd want to say is when we're doing this two-step calculation, that total stockholders' equity, preferred stockholders' share of equity, and the shares of capital stock outstanding, those all come from the statement of stockholders' equity. So note that the three pieces and parts that we need comes from the statement of stockholders' equity. And what I've done then is I take my entire equity for the company and I take out the preferred piece. So I take out the share of equity that is attributed to preferred stockholders. And the way that I get that is I take the par value of preferred stock and I multiply it by the number of preferred shares outstanding. So I would maybe write that down. So take the par value of preferred shares times the number of shares of preferred stock outstanding. And then I'm left with just the common stockholders' share of equity. Take that number, just copied it down here, divide by how many shares of capital stock I have, and that's how much the common equity per share is. So what that's saying is that at December 31st of X3, each share of common stock represents ownership in $5.75 of the assets. And positive and growing is better, so the trend is good, and that is what we would prefer. And that's really all I'm going to say about that. Otherwise, we obviously just want to drive that number up. So we can do that through either common stock or preferred stock in what we do. The fourth ratio that we have related to long-term financial strength is something called interest coverage ratio. And we're going to talk about EBIT as well. I've heard it called times interest earned a whole lot more than I've ever called it this. So you'll hear me saying times interest earned when talking about it. But in order to calculate it, we got to understand what EBIT is. And earnings before interest, expense, and taxes. So the E, the B, the I, the T. The I and the T. And EBIT is used in the calculation of quite a few ratios. And it's basically trying to tell you how many times a company can cover its interest expense with its earnings. So that's what we're looking at when we do this one. And so let's look at it for Forrest and how calculated. So EBIT and interest expense. Those numbers are coming from the income statement. So make sure that you note that. And we've calculated 3 years because we're using income statement stuff, and that is 3 years worth of data. So we look at the interest coverage ratio, and it's gone from 27 to 16 to 11. And what that 11 means is that earnings can cover the interest expense 11 times. It used to be able to cover it 27 times, so it's gotten worse. But the key is we have to compare it to a standard or a target, and a target is 2.5. so 2.5. So at 11, they're clearly better than 2.5, so they're still doing well. If it's less than 2.5, what I would talk about is that two things. You either may not be able to pay your annual interest expense. It's starting to look a little dicey whether or not you have the strength to do it. And then banks probably are going to hesitate to lend any additional funds to you, because if you can't cover your interest expense that you currently have and exists, they don't want to give you more interest expense by letting you borrow more money that you may not be able to cover. So that's what we would notice. So that wraps up section 13-1. We talked about who the users of financial statement analysis are, what the objectives of that financial statement analysis are, and then we talked about the first set of ratios, which is financial strength ratios, short-term and long-term. There were 3 for short-term and 4 for long-term, and you'll need to know how to calculate them, what the targets are, and how to